Hello and welcome back, traders. This is the ASTROFX team, and let's begin with a happy new year to all of you guys that are with us right now. Now, one of the New Year's resolutions that myself and Sean made for 2016, we're going to bring back these videos because we believe our last video was towards the end of November, beginning of December. So it's our first video back. We hope you enjoy and take something away of value.
That's right. So today's topic is the monetary system and the Federal Reserve. We're going to be going deeper into exactly what the Federal Reserve is and how they operate, why there is a Federal Reserve, when they were created, and much, much more.
So we broke this video down into 3 simple sections, which we believe are easy to understand and easy to digest. And from viewing some of the material now on YouTube, discussing the monetary policy or the Federal Reserve, it can be a bit complicated. So our job is to make that easy and break it all down for you.
So we hope you all enjoy the video and the information we are about to present is of some value to yourselves.
So the video and talking points today will be affecting everyone watching this video, whether you're a currency trader, whether you're a homeowner, or you're dealing with money in any particular way. So let's get started with the introduction of the Federal Reserve.
Now, the Federal Reserve, i.e. Fed for short, is in fact a central bank. Every country has a central bank, i.e. the Bank of England, the European Central Bank, and the Bank of Japan, just to name a few.
However, the Fed is the most important. Why? Because it actually governs the US dollar, and the US dollar is the world's reserve currency.
That's right, hence why the FX market is in fact a dollar-based market, the world's largest market, and all of the major currencies all include the US dollar.
So let's go into the name Federal Reserve. Now, the name Federal Reserve is actually a deception in itself. You might be thinking, how is that? Well, let's actually go into the name Federal. What if I told you they have nothing to do with the federal government?
That's right, guys, and the name Reserve, believe it or not, these guys actually have no reserves to back up all of the currency that they are putting into circulation.
And let me give you 2 facts. Number 1, Federal Reserve, they actually like to hide the fact they're not part of the government. And number 2, by choosing such a clever name as the Federal Reserve, they'll raise no questions amongst the general public.
Now, let's get into how exactly this organisation got all of its power.
Now, in order for us to continue to tell you in detail about the Federal Reserve, first of all, we have to go back in time to tell you how this all came about. And for that, we need to share 3 very important dates in history with you, beginning with the 1907.
That's right, the year 1907 was one of the first official points in time where the standardised banking system actually failed on the people. There was panic and chaos in the streets of America as people rushed to their banks in order to withdraw their funds. However, the major problem was the banks didn't actually have any funds to give back to the people. This actually led the country into a state of recession, and the major problem was there was no centralised system that could actually help these banks in times of need.
So, now we have to travel 3 years later, when we get to the date 1910. Now, this was actually where the idea and the conception of the Federal Reserve was actually created. Now, the Federal Reserve was actually an idea between 6 of the most wealthiest people in America, 6 bankers, let's say, and policymakers. Now, this meeting happened on JP Morgan's estate in Georgia, USA. And as legend says, all of the bankers came there on a late night train. It was that secret that not even the people that worked on the estate of JP Morgan knew the meeting was going to go ahead. This is where the idea was formed. Now, 3 years later, we go to 1913.
Now, the year 1913, December the 23rd to be exact, this was the official birth of the Federal Reserve. It was the 28th president of the USA, who was President Woodrow Wilson at the time, who actually signed over power from the US government over to this group of wealthy elite bankers, which gave them ultimate power and control over the monetary system.
Now I'm going to go over some of the roles for the Federal Reserve. Now, all of the different roles, we've selected some of the top 3 in which we feel are the most important. Number 1 is to issue currency. So they are the ones that will actually print and deliver money and pump it into the United States. Number 2, interest rates. Now, they don't have to ask anybody's permission. It's up to them how much and when they want to change the interest rates. And number 3, to try and keep a strong economy. Now, of course, they actually do this by changing the interest rates, by trying to report and analyse how the economy is actually doing.
So more facts about the Fed. Not even Congress or the United States President are allowed full oversight into the inner workings of the Federal Reserve. Also, in over 100 years, there's never been full transparency from the Federal Reserve as to where the spending, etc., has gone to the American people.
Now, a good example of this is on a particular occasion, the chairman at the time, Ben Bernanke, in 2009 had to testify in front of Congress and try and explain where $2.2 trillion had gone. And he didn't want to reveal any names, and he just stated that it had gone towards bailouts and loans. And in total, over $16 trillion of the taxpayers' money has actually gone and evaporated into the Federal Reserve, with no explanations again except bailouts and loans.
So isn't it very ironic that if you're a member of the public and may own a business, etc., and you do not give full transparency on your earnings, tax reports and so on to the IRS if you're a US citizen, and to the HMRC if you're a UK citizen, there is a chance you could be prosecuted and actually go to jail.
So, however, if you're a private organisation like the Fed, you can do as you please. So the same accounting laws that apply to us do not even apply to the Federal Reserve.
Now, that's right, so we're now going to go deeper into the relationship between the Fed and the United States of America.
So now let's explain exactly the relationship between the United States and the Federal Reserve when it comes to money. Because a lot of people are under the impression that the United States decides when and how to receive money, which is not true.
That's right, so once upon a time, all money which was printed into circulation by the Federal Reserve was in fact backed by a precious metal, which is gold. 1929, the Great Depression, banks needed extra help, so half of that gold standard was then removed to allow extra printing of money to feed the economy. In 1971, the remaining gold standard was then removed by President Nixon. So since 1971, all money put into circulation by all of the central banks is not actually backed by anything.
So, in other words, when the United States does want money, it has to actually ask the Federal Reserve. And the way it asks for the Federal Reserve is like this. Because a lot of people assume that it might be a phone call or any kind of request, but it's actually using something called a treasury bond, which will be up on your screen right now. So here we have the United States. Now, the United States issues and creates something called a treasury bond. Now, that treasury bond, they actually sell to the Federal Reserve. When the Federal Reserve receives this bond, then it decides to basically go and print money in their factory or however they wish, physically and digitally. Once printed this money, of course, it has to send it back to the United States. Now this is where it gets very funny. So the United States actually gets this money, but then gets charged interest on this money. Now you might be thinking, how does that work? Because the Federal Reserve are the ones in charge of how much money is in circulation. How could they possibly ask for more money back? And this is how people say that the United States and the American people are forever in debt.
Now, let's go into further detail into exactly how the Federal Reserve provides money to the major banks, which again impacts you, the consumer.
Now, this can get a little bit confusing, so just stay with us. So at the top of the food chain, we have, of course, the Federal Reserve. Now, the Federal Reserve is going to supply money to the major banks. Now, these banks could be, for example, JP Morgan, they could be Citibank, and any of the major banks within that category. Now, exactly like the example before, an actual bond needs to be created from the banks to ask the Federal Reserve for this money. Let's say, for example, it's $1,000 in this example. Now, then the Fed will go to the printing machine and give that 1,000 over to, for example, JP Morgan. It will then deposit that 1,000 to and within their bank. Now, the rule in which the Federal Reserve have is that this bank must always keep 10% of that in reserve. So, for example, $100. But the other 90%, which will of course be $900, they can credit and leverage out to the people as a loan. Now let's create Jim over here. Jim over here wants to take out a loan, and obviously can take out a loan for $900. So he does. And obviously people usually take out loans for an actual purpose. So let's say he purchases something. It could be a painting, it could be a car, it could be a house, it could be anything. Now, as a business or service, once received at $900, the payee will then deposit that money back into the bank. However, you have Jim here who still owes that $900. So sooner or later, he of course then gives back that $900 to the bank. Now, this is an example of how this worth of $1,000 to the bank, after being given out and paid back by Jim, has now been created into $2,800. Now, if we were to repeat the process, remember the rule, it has to keep 10% of it in reserves, which will be 280, and the other 2,520 it can give out to, again, as a loan. Now let's say Jim has then told his friends, through Sean's amazing microphone. Jim and his friends now have the opportunity to again take out this loan of 2,520. Again, giving it to a business, so it creates it that way out of thin air, and giving it back to the bank. And this, unfortunately, will keep on continuing to this original 1,000 might become 10,000 or 15,000. This is called the American debt machine.
That's right, so as all of the money supply from the Federal Reserve is not backed by absolutely anything, this only dilutes the currency flow. Furthermore, the purchasing power of the money actually declines, which is known as inflation. Now let's go into further detail regarding the Fed's most important job role,
which is again changing and manipulating interest rates. So the Fed's overall goal is to try and keep a good and strong economy. So using a scale for an example, we're going to try and break this all down to you for you to understand. Now let's say the Fed decides to charge a low interest rate to the banks, which is a low interest rate for us. Now this will lead to more borrowing, because again, it's a lot cheaper to borrow from the banks. This will then have a knock-on effect and lead to more spending. More spending and probably unnecessary spending for the public. Now this will lead again to overflowing money in circulation, basically in the economy, which could rise the price of everyday goods, for example bread, milk, etc., which will then lead to inflation. Now how can we battle inflation? This is not good for the Federal Reserve. What will happen is instead of charging low interest rates, we have to charge high interest rates. Well, the Fed can. And this will pump a brake on a lot of different things compared to on this side. So the first thing that will happen is it'll be more expensive for people to go and loan from the banks. Now, if people are borrowing less, this will mean, of course, they spend less. Less spending in the economy will affect businesses and services, which could then lead to a lot of unemployment and a lot of sales declining. Now, if that happens, there's only one thing that will lead to, which is, of course, recession. So again, as you can see, it's a constant battle of this scale of low interest, but too much low interest leads to inflation, and if we try and charge high rates, then that will lead to recession.
Now this is just a basic example which merely scratches the surface. So to conclude, a low rate of interest may stimulate mass spending, more liquidity provided by the central banks, however, will dilute the purchasing power of the currency. Whereas higher interest rates may help to balance out the economy, but people may struggle with paying credit cards, loans and even mortgages. This puts a temporary hold on the dilution of the purchasing power.
So I hope that example made it all easy for you to understand, and now let's move on. So now you might be wondering who within the Federal Reserve actually dictates whether interest rates rise or come down. Now this decision is made by a group called the FOMC, which stands for the Federal Open Market Committee. Now, FOMC, whether you're an FX trader or you just like to stay on top of the Financial Times, this name will be quite familiar to you.
That's right, so this group of 12 people get together 8 times a year to review all of the macroeconomic releases. This group is led by the short and evil-looking lady, Janet Yellen, who is the head of the Federal Reserve and needs no permission whatsoever to make modifications, just like the prior chairman, Ben Bernanke.
So whether you're purchasing a house, or you're borrowing some money, or you're an FX trader who just wants to stay on top of the market, hopefully all of this information now sinks in for you. Let's put this in perspective. Since the few decades that the Federal Reserve has took over, we've received a number of financial problems.
Yes, so firstly, starting with the Great Depression, which we've already mentioned, which lasted between the years of 1929 to 1931. After that, we had a period of severe inflation and high unemployment during the 1970s, which was shortly followed by a major banking crisis throughout the 1980s. The most recent and most severe was the financial crisis and recession of 2008, where many banks around the world failed and mass amounts of money needed to be printed in order to prop up the economy.
As many people know, the Federal Reserve policy of credit was the main contributing factor of the 2008 crash. Instead of, however, shutting it down, the Federal Reserve has been given even more authority beyond the monetary policy and the banking sector. So what does this mean for us the people? Now let's give you a good example using a simple concept and everyday goods such as bread and milk.
That's right, so since 1915 alone, 2 years after the Federal Reserve was created, The price of everyday goods have absolutely been skyrocketing. Reason being is because so much money has been put into the economy at interest, which is fictional, and there's been no backing of precious metals. So what has that done? As already mentioned, it dilutes and decreases the purchasing power of the notes, which is often reflected in the price of goods. So let's give you an example.
So let's show you the difference between the cost of goods in 1915 and today's day and age, 2016. Now let's take, for example, a loaf of bread. Now in 1915, a loaf of bread would have cost you roughly about 1 pence. Now, in today's day and age, here in the UK, it would cost you roughly £1.35. Now this is an increase in more than 11,000%. Now, let's take milk, for example. Milk would similar cost 1p. And today's day and age, you're looking at roughly 46 pence for the same milk. Now this is an increase in roughly 6,500%. Now this isn't mind-blowing enough. In roughly 100 years from now, these figures suggest that just simply a loaf of bread which costs £1.35, you could be looking at costing £150. Crazy, right?
So what does this hold for the future? So apart from severe inflation and our monetary system being diluted, we also have to consider the Federal Reserve has to reverse the bond buying program. So as we went through on the board earlier on, the bond is issued from the major bank to the Fed in exchange for a lump sum of cash. However, at one point, whether it be a few years down the line, the bank then has to pay the Federal Reserve back with interest on top, which again was made out of nowhere. So this interest could come from higher taxes, higher prices of goods, which all vary throughout high and low economic activity.
And before we go, let me give you guys a quote to think about. Now this is a quote from Mayor Amschel Rothschild, who says, "Let me issue and control a nation's money, and I care not who makes the laws." So next time you try and blame society for money problems, or Congress, or the government, or even the United States President, just remember no one is allowed full oversight of the Federal Reserve, as the Federal Reserve is then one of the biggest robberies done on the American people.
Yeah, that's right. So we hope you enjoyed this video and took something away of value. We're going to be back with more videos such as this one. So have a great trading week, and we'll see you soon.
Thank you guys for watching.